Thank you for checking out Real Talk Personal Finance. Shit's about to get real. Cash Flow King with you today. And in today's episode, we have financial bloopers when tax gain harvesting backfires. Before we get into today's show, just want to take a couple moments here to let everybody know how much I appreciate you guys listening to the show, as always. So thanks for tuning in. Hopefully this was a nice, pleasant surprise. As we've mentioned on our last episode of 2024, we are no longer going on the strict cadence of every single Monday, but rather whenever the fuck we feel like it. So here we are, and I'm recording a show. We got an email that came in from Cashflow Rockefeller Prince. Subject line says, "Welcome back." And he wrote this back when the last episode, or I should say first episode of 2025 dropped in February. He says, "Hi, Cashflow King. Welcome back. Just listened to the new episode. I typically listen to all my podcasts on Monday morning, and when I didn't see a new one from you last Monday, I said to myself, if I don't get a new episode by the end of February, F this guy, I'm unsubscribing. So I was happy to see you dropped an episode on Thursday of last week. In regards to the episode, I like the personal conversation you had with the client of yours who is freaking out, which, by the way, for those of you that listen to that show, haven't heard dick from her since. She's not reached back out after she was going to talk with her spouse about some stuff, so finally she apparently has calmed the fuck down. He says, as a new investor myself, I hate seeing those swings, but I know it's a long-term play and it's expected. Out of curiosity, at what point should someone say, hey, I've had like weeks of big negative swings, that you should sit down with an FA and say, what the fuck is going on here? Hope everything is well and look forward to new episodes. Thanks. All right. Well, Cashflow Rockefeller Prince, thank you for the feedback. I'm glad to see that you have not unsubscribed. Those of you that have been longtime listeners of the show know that Cashflow Rockefeller Prince is a premium subscriber, and we appreciate that. I also think, I don't know if he's been able to put a number to this, and Cashflow Rockefeller Prince, I'd be curious, and if you've ever put some numbers to this on how much money you've made as a result of listening to the show and being a premium subscriber. I know that you won at least one of the gift cards. I know that you were crushing the bank bonuses, and you got on our cashback portal, and you're rocking that now. I would venture to guess, I don't know for sure, probably well over $1,000. So not bad for a few bucks a month. We're glad you didn't unsubscribe, and we appreciate you. To answer your question about at what point should someone say, hey, I've had like weeks of big negative swings, and you should sit down with an FA and say, what the fuck is going on here? I think you need to see your previous sentence, which states, as a new investor myself, I hate seeing those swings, but I know it's a long-term play and it's expected. There's your answer. I really don't think that due to any sort of market volatility or market-based fluctuations, that necessarily is going to be a triggering event for somebody to sit down with an advisor specifically for that reason. Now, if you or anybody, you generally speaking, are feeling that way, if we dig a little bit deeper, there's probably a fairly high likelihood that the reason from that or for that stems from something else. So, for example, if markets are volatile and you're seeing some major swings in your portfolio and it makes you really, really uneasy and you feel like you might need to take some sort of action or that you might need to sit down with somebody, that could just be, getting used to the swings in investing in the stock market. That could be based on somebody's personality. Or if we dig a little bit deeper, it could be, hey, this person, and I'm not saying that this is you, Cashflow Rockefeller Prince, but this does happen, that person is thinking, you know what? I'm getting closer and closer to retirement. I really don't have a plan. I really don't know where all the places that my retirement income is going to stem from, and I need to figure this out, and if my account keeps dropping and going fucking down, then where's that money going to come from, right? So that's just a quick example of something that, somebody might be having a conversation with themselves, sort of a inner dialogue, if you will, of, hey, here's how I'm feeling about things. I don't feel prepared. I don't have a plan. I'm running out of time. Oh, what the fuck do I do? And I think that's the case for a lot of people. And then again, there's going to be some people that just feel uneasy about those fluctuations, especially if they are, as you mentioned that you are, relatively new in the investing space. They've not experienced those types of swings before. And, that's just kind of the way that it goes. But I don't think you should, hey, I've been down for several weeks consistently. My portfolio is down X%, and all of a sudden I feel the need to randomly go out and sit down with an advisor. Not saying you shouldn't have an advisor, not saying that you shouldn't do that, because quite frankly, for a lot of clients, and we kind of joke about this in the industry, we have to talk them off the ledge. And that's what they pay us to do. Yeah, there's optimal portfolios and there's the efficient frontier and all that fucking geeky shit, right, that some people care about. Most people don't. But at the end of the day, they just want somebody sometimes to talk to kind of talk them off the ledge and, show them that, hey, generally speaking, markets go up over time, over long periods of time. This is going to be more than likely a very minor setback when it does happen. And we just need to stay the course. And oh, by the way, we need to do that in the context of a bigger plan if we have a plan, and hopefully we do. So I don't know if that answers your question or not. Hopefully it does. But I don't think that if you're seeing some market turbulence that you should jump to sit down with an advisor necessarily, unless you think, hey, you know what? I might do something stupid with my portfolio. I might sell out of everything and go to cash. I really need to come up with a plan. I don't want to fuck with it myself. I'd rather somebody else manage this for me. Okay, maybe then you can make an argument. Go ahead and seek out an advisor and, probably talk to a few of them, interview a few of them, and then go where you're most comfortable if that's what you desire. But I don't think that you necessarily have to do that strictly as a function of markets going down when they go down. So I hope that answers your question. And again, thanks for writing in. Okay. Anybody else that wants to write into the show, as always, realtalkpersonalfinance@gmail.com. You can send something into the show. You can feel free to write in anonymously if you'd like to. We like people that like to write in with code names. It makes it fun, as everybody knows. We do this show anonymously, although we are real people, but where you don't need to give your full name or your real name if you don't want to. So if there's something that's on your mind or something you want to say or feedback or questions you want to send into the show, feel free to use a throwaway email if you want to and fire off something to realtalkpersonalfinance@gmail.com. Don't let that stop you. All right. Special announcement. I've alluded to this, I think, or mentioned this on a couple of other shows, mostly, I want to say, coming into the end of 2024. But for anybody that's in the area or interested, you will have the real live opportunity to meet myself and Cube Crusher, if you so choose, out in Las Vegas in a couple of weeks. So if that's of interest and you're in the area or you plan to be in the area around that time, shoot the show an email, realtalkpersonalfinance@gmail.com. We'd love to connect with you and buy you a beer. All right, so let's get into today's topic, which is a financial blooper when tax gain harvesting backfires. Okay, so let's take a couple steps back here. First of all, what the fuck is tax gain harvesting? Before we get into that, we first need to understand the more common phrase, which many of you might already be familiar with, which is what we're used to hearing, and that is tax loss harvesting. And we're not going to go down and get too deep into that. But before we get into any of this, I want to say we are talking specifically in the context of taxable non-retirement investments. And that's very important. So when it comes to things like your 401k or your IRA or Roth IRA, different retirement accounts, which we often talk about on the show, what we're going to cover today does not apply to those types of accounts, right? So if you have most retirement plans, if they're pre-tax funds, then generally speaking, you are going to pay ordinary income tax when you withdraw from those plans, right? If they are Roth plans and you take what's called a qualified distribution, in other words, you play by the rules, that money will ultimately come out completely tax-free. So those accounts are not what we're talking about here. What we are talking about are taxable brokerage accounts, okay? Or some people might just call them individual accounts. These are investment accounts that you start that you can do at any age, at any time, regardless of the sources of income that you have. In other words, For most retirement plans, you or a spouse has to have essentially compensation or basically earned income in a lot of cases to make contributions. You can't just take like pension or Social Security money if that's all you have coming in and put it into a retirement plan. That's not going to work. Not true for these individual accounts. So regardless of your income sources, where your money is derived from, where that money is coming from, what age you are, how young you are, how old you are, doesn't matter. Pretty much anybody can start a taxable brokerage account. This is an investment account where there's no limits, no age limits, no financial contribution limits, no distribution limits, no fancy ages to worry about. I can't take it out before this age. None of that shit, okay? Now, when you look at the order of operations, so to speak, in terms of where money should go, like if I have $1 that comes into my life, where do I put it? Does it go into a retirement plan or a non-retirement plan? Does it go into a savings account? Does it go into an HSA or an FSA, right? That's kind of a separate conversation, which we probably covered on other shows. But a lot of people, just because there are typically higher ranking priorities for a lot of people in terms of the accounts that they want to fund, a lot of folks don't necessarily have a lot of money in these types of accounts, especially if they're really not on the early retirement train, so to speak. So those that are considering early retirement, and that's going to be very subjective and mean different things to different people, more often than not, those folks will have accounts like this. And quite frankly, this show is probably just a quick refresher or review. You may or may not, you may already be familiar with the things I'm going to talk about today. But a lot of people don't, right? They just have a little bit of money in the bank. They got their 401k at work. Maybe they got a Roth IRA they put a little bit of money into, and that's it. And if that's the case, that's fine. Definitely stay tuned and learn about this shit. But just know that what I'm going to talk about does not apply to those types of accounts, okay? Now, let's assume you've put whatever money that you want to put in those other accounts, right? You funded whatever you need to fund, you're good to go, and now you've decided to start this taxable brokerage account. Maybe you've started contributing to it and investing within it for a period of time. Well, depending on the types of investments that you buy, which again, we don't give any advice on the show, so do that, however you want to do it, right? Some of those investments may have some gains, right? Some unrealized gains, right? So it means that essentially you put money into an investment, it goes up in value, you haven't sold it, so that's an unrealized gain in terms of appreciation on that. I bought an investment for $1 and it's now worth $1.50, so I have 50 cents of unrealized gain in that particular investment within that taxable brokerage account. So that could be true. And then you may also have some investments that shit the bed on you, and you put some money in, you put the same dollar in, all of a sudden it declines to 70 cents, and now you have an unrealized loss of, in that case, 30 cents in that example, right? So what most people hear about, and a lot of folks talk about, and quite frankly, this can be useful, but they make it sound, I don't want to say better than it is, but in a lot of cases they make it sound better than it is this idea of tax loss harvesting, where if you're going to sell some winners and you're presumably going to have to pay taxes on those capital gains, then you may want to offset that by selling some losers, and therefore you're doing this tax loss harvesting. And you can essentially net them out, and there's a specific order that happens. We're not going to cover that right now. But the idea being that you want to try to net out your losses against your gains so that hopefully you can reduce your tax bill on those potential capital gains to zero, and in some cases you could create a small loss. There's some very strict and nominal amounts. I think it's $3,000 if you have a net loss that can be used to offset ordinary income, and then beyond that is a carry forward. We don't give advice on the show. I am not a tax professional. We don't give financial advice, tax advice, legal advice, any advice. We do this for education and entertainment purposes only. But the point is, that's what most people think about when they talk about this whole harvesting thing. It's usually tax loss harvesting. What we're going to talk about today, I think, when done correctly, can be even more impactful than that in the right situations, but it's often very much misunderstood, and that's where it leads into one of the bloopers I'm going to share with you. But this is called tax gain harvesting, okay? So what the hell does that mean? Well, again, not tax advice, not a tax professional, but when we look at this, and quite frankly, I do think this is very much misunderstood. In fact, when I went to Google and typed in capital gains tax rates, one of the first, if not the first, top search result was from NerdWallet, and they go over capital gains tax rates, right? So the very first article that comes up here, capital gains tax, how it works, rates, and calculator. Now, I will say, and I'll put a link or try to remember to put a link in the show notes here. Their calculator is actually pretty fucking good, and it takes into account all the shit that it's supposed to. But their article sucks, okay? The way that they explain this in terms of how it works, they're really only telling you part of the story. And so I do want to spend a little bit of time on this because, again, I think this is something that is often overlooked. And even for somebody that's seeking out that information and goes to Google and types in that information, they're not going to find the complete story just based on that top search result article in and of itself. So what we have to understand is that there are different tax rates for different types of income, okay? And what you'll see if you look this up for capital gains tax rates, what you're going to see is a little table, and they have it listed for 2024, okay? So for those of us that are filing taxes, which hopefully at some point this year is everybody, in 2025, for tax year 2024, there is a table. And that table has different filing statuses, so different columns for that. And then it has 3 different rows underneath the heading tax rate. So from top to bottom, you're going to have a tax rate of 0%, 15%, and 20%. And again, this episode is designed to be informative, but not all-encompassing and completely exhaustive. So there's going to be things like, for those high-income earners out there, net investment income tax of 3.8%. We're not going to cover that on today's show because it's not going to apply to most people, right? There's going to be little nuanced things like that still need to be taken into consideration. So as always, consult a professional tax advisor for any, of your tax-related items. But what I want to spend the time on is how this actually works and how this is going to affect or potentially affect most people. Most of the time, most people will pay 15% on what's considered to be a long-term capital gain. So what does that mean? And again, there's going to be exceptions. There's going to be different investments that are collectibles and metals and bullshit that can be taxed up to 28%. Not going to cover that today. I'm talking about your typical vanilla, stocks, mutual fund, ETF type of shit, right? And just your taxable brokerage account. Again, this is a non-retirement account, and you have a gain there. Most people are going to pay 15% if it's a long-term capital gain. So to understand what a long-term capital gain is, we first should explain what a short-term capital gain is. A short-term capital gain is for a gain in an investment that you have that you end up selling in 1 year or less, or basically less than 1 year. And that's going to be taxed based on your ordinary income tax rate, which is going to be another table, right? That's where the 10, 12, 22, 24, 32, 35, 37, those are ordinary income tax rates, right? And there is some interplay between these two. There's actually quite a bit of interplay between these two to really fully understand this. But before we get back to that, the short-term capital gain will be taxed at your ordinary income tax rate, which is generally, for a lot of people, if you're making any reasonable amount of money at all, ballpark double. Not quite, but double. In other words, if it's a long-term gain and you're only paying 15%, but it's a short-term gain, depending on your income, you could be paying 24% or 32%. So that's why I'm saying roughly double. It's not going to be exact. But most people will pay 15% on a long-term gain. So what is that? That is any investment that you've held on a capital asset for 1 year and a day or longer. So the longer you hold it, if you sell for a gain, then generally speaking, the more favorable the tax treatment is going to be. Now, if you look at this article from NerdWallet and you just look at this one table, again, it's broken down by filing status, you're going to see 0, 15%, or 20%. Now, there are folks out there that have nominal means and nominal amounts of income. Typically, it's going to be retirees where they can generate a decent amount of long-term capital gains and theoretically, and in actuality, if they do it correctly, pay 0% tax on those gains. So for example, if you have somebody that's married filing jointly, on the first $0 to $94,050 of taxable income in terms of capital gains, they could theoretically pay 0% tax. Now, if you just look at the table, you might think, okay, so this just applies to my long-term capital gains. In other words, if I sell investments that I've held for over a year and a day, and I generate up to, we'll call it, just to keep the number simple, $94,000 of gain, that theoretically I wouldn't have to pay any taxes on that. And that's actually not true. This is where the blooper comes in. So capital gains are actually added on top of income that applies to your ordinary income tax brackets. So it's essentially stacked on top of each other. If you picture like building this out from bottom to top, at the bottom, the first, essentially portions of income, if you will, are going to be related to things like, hey, I went to work and got a paycheck. Hey, I own a business, I paid myself a salary or whatever, right? You're going to have ordinary income, typically from earnings, that are going to be taxed at different rates. Then, if you have capital gains, those are going to be stacked on top of that. And so it is the combination of the two that is basically going to determine if you could possibly get away with selling these assets at a gain and paying a tax rate of 0. And I say paying a tax rate of 0 because that's technically what it is. It's not that you're not taxed, you are taxed. In fact, with tax gain harvesting, you're basically saying, hey, I want you, IRS, to go ahead and tax me on this, right? And from a federal standpoint, every state's a little bit different. But for federal, if you're within these thresholds, you could theoretically pay 0% tax, which is a great way to basically step up the basis in your taxable investments over time if and when it makes sense to do so and you have, lower income years where this could work. Again, the problem is they make it seem like it's just the gain on those assets that has to fall within this range, but the reality is it applies to all your income, including your ordinary income, on which these capital gains get stacked on top of. And so that's where the blooper comes in, right? Because you're obviously going to have things like your standard deduction. Some people might itemize, but this is based on taxable income, right? So you're looking at, okay, well, what is my adjusted gross income? I have all my above the line deductions that possibly could come in. I have my ordinary income. I figure out where I'm at with that. Then I go ahead and add in my capital gains on top of that and then see where I shake out. So for most people, let's say you're married filing jointly, if you're between $94,000 and $583,000 and change, then it's going to be at 15%. And that's why for most people, the answer is, hey, if I have long-term capital gains, I'm going to pay 15% tax on that gain. But again, there are some situations where you could theoretically pay 0. So where this gets a little bit complicated, and one thing that they don't mention in this article, again, is the interplay between these capital gains rates and ordinary income rates, right? So there's some interplay there. But then also there's other considerations, especially when you think about this in the context of a retiree, because for most of them, what kind of income are retirees going to have? Well, some of them, if they're lucky enough, depending on how long they've been retired and where they worked during their career, they may have a pension. They may not. A lot of them, especially now, if you listen to last episode about the Social Security Fairness Act, or as some people call it, the Unfairness Act, they're likely going to have Social Security retirement benefits as well, right? And that there's we'll put a little carrot there because there's a very special formula that determines how much, if any, of somebody's Social Security benefit becomes taxable. And then they might have distributions from retirement accounts, whether it's 401ks or IRAs or, whatever. So I think the first mistake in this particular case was the fact that, was just looked at that, we're just going to worry about the gains and not the rest of the income. So if the gains are under a certain threshold, then we're going to pay 0% tax. Again, that's not true, right? The other thing that would apply is that this particular person on the blooper here, they actually were receiving Social Security retirement benefits. And for those that aren't familiar, there's 3 different tiers in terms of how much, if any, of your Social Security retirement benefit is taxable. And by the way, when I say taxable, we're talking about based on the ordinary income rates, okay? And these numbers, and we probably talked about this before, probably on our Social Security show, that these numbers have not been indexed for inflation in a long, long time. So even though there are items that are indexed for inflation pretty consistently, this is not one of them. And so if the person is on the bottom tier of the 3, then they could potentially pay no tax on their Social Security benefits. If they're in the middle tier, then up to 50% of their benefits could be taxable. And if they're on the top tier, up to 85% of their Social Security retirement benefit could be taxable. Well, how do we determine which fucking tier we get on? Okay, used to be called provisional income. Now it's called combined income. A lot of people in the industry still call it provisional income. And there's essentially a formula that determines where you end up in these tiers. So they're going to take things like your adjusted gross income or your AGI. They're going to add back in things like non-taxable interest. For example, if you had interest from municipal bonds. And then they're going to take half of the Social Security benefit itself that you're receiving. Now, why am I bringing this up? Because in the case of the blooper, the capital gains that were triggered for somebody that was trying to do tax gain harvesting, they were trying to harvest these gains and step up their basis in their taxable brokerage account and pay 0% tax on the gains of those investments. However, as we talked about a few minutes ago, the way that it works is that those capital gains are going to be stacked on top of their other sources of income, and they're going to add to their AGI, to their adjusted gross income. So it stacks on top of that. Well, what did that do? A couple things. Number one, with this person, they ended up above the threshold where they could pay 0% tax on their capital gains. Why? Well, a couple reasons. Number one, the capital gain itself was added to their income, like I mentioned. But number two, because of this formula that determines how much, if any, of their Social Security benefit is taxable, they had a situation where they were paying taxes previously on less than half of their Social Security benefit. But because now they triggered capital gains, and that adds to the adjusted gross income, which is included in the provisional income and combined income formula, all of a sudden now they went from the second tier to the top tier in terms of how much, if any, of their Social Security benefit is taxable. So they went from being taxed on less than half of their Social Security benefit to having to pay taxes on up to 85% now of their Social Security retirement benefit, in addition to having to pay the long-term capital gains tax no longer at a rate of 0% because they went above the threshold, but now instead, the vast majority, if not all of that, they were having to pay it at 15%. So it was a double whammy. It was well-intentioned, and the idea was to generate some gains and do the tax gain harvesting at 0%. However, because of the interplay between how these things work, it turned out that not only did they have to pay tax of more than zero, closer to 15% on the long-term capital gains, but now they ended up in the top tier for Social Security, which means that more of their Social Security benefit was taxable, which again is taxable at ordinary income. And so it was a double fucking whammy and a well-intentioned strategy that had the right thought process or the right the idea, I guess you could say, behind it. When it came to the execution, it did not end up as originally planned. So I wanted to share that with you guys because, again, I think this is something that is not very well understood. I know for many of you, you may have to go back and listen to some of that again, and that's okay. I don't claim to be an expert in this area, but again, it is very important. And the biggest takeaway, if you remember nothing else from this episode, is that when you're looking to determine how much, if anything, you're going to pay on your capital gains, your long-term capital gains in terms of taxes, you need to remember that whatever gains you're triggering are going to stack on top of your other ordinary income. And when you take those two components together, that's where you need to look at where is that on this grid for capital gains rates. Because it's not done separately. It's not like they say, okay, you're going to have your, ordinary income taxed at your ordinary income tax rates over here on the side, and then separately we're going to pull up this capital gains tax grid and figure out what you had for long-term capital gains, and you're going to pay that on this side based on that grid. And unfortunately, that's what a lot of people think, and unfortunately, that's what a lot of even these sites like NerdWallet, when they go to explain this shit and they put these, tables in there, of course they can't go into that much detail in a single, article, right? So again, I think their calculator, the capital gains tax calculator, I'll try to link to that in the show notes, is good if you're curious. But you just need to remember that there's a lot of interplay between these two things, right? You have to figure out ordinary income tax. Then you also have the capital gains taxes or the capital gains that are added on top of that. Then you have to figure out things like standard deduction versus itemized deduction. You got to come up with what is the taxable amount, and then where does the taxable amount fall in that grid when you lump everything together, essentially, and that will determine essentially where you end up on the long-term capital gains tax rates. So again, not tax advice. You definitely don't want to take tax advice from me because I don't give tax advice. I'm not a CPA. I'm not an enrolled agent. However, this stuff is important. And if you're thinking about implementing any of these strategies or trying to do some sort of long-term capital gains harvesting in the future, you may want to get with your tax advisor and make sure that you're looking at all the angles. Because in the case of the blooper, this person did not do it that way. And unfortunately, the result that they got was not a favorable result. So hopefully you guys learned something today. I hope that's helpful in some way to you. And if you have any questions, again, email the show, realtalkpersonalfinance@gmail.com. And we will see you in the next episode.
Check the mic and make sure it sound right, boys.